Thanks very much for your time. Well, Anshul Sehgal is with us now. He's head and executive vice president at Kotak PMS. If I'm not mistaken, another Delhi boy. Anshul, good to have you with us here. Thank you very much for your time. Good afternoon. How are things at your end, Anshul, looking at the way markets have come off? Quite a bit, right? I mean, over the last many days, last many weeks actually, and much more than some of the other markets in the Western world, where many of these global problems come from. Are we looking sort of sold enough so that there may be a little bit of a tactical turn? Many have been expecting that. Go on.
Hi, Prashant. So till 5 minutes back, my situation was very good. We are sitting on some cash. Now I'm wondering whether I should be investing it in stocks or Chola Bhatura and Gulab Jamun. So
food will always get you good returns, Anshul. Food, as long as it's quality food, you don't have to wait for timing or anything of that sort. It's instant returns, right?
You know, someone on Twitter mentioned, आप भटूरे मंगवा, आप छोले मंगवा लीजिए, भटूरे घर पे बना लीजिए. That's a solution to hot. Anyway, Anshul, go on. Sorry.
Yeah. So you're absolutely right, Prashant, on that. The market is quite bearishly positioned. FII is holding record shorts. Domestic institutional investors holding record cash. This is a setup for not material downsides. On the other hand, you have seen in recent times credit events play out globally. But even on those credit events, we have seen that the US Fed, which whether we like it or no, drives global markets. The US Fed has come out and said that they want to backstop any volatility or any adverse action in these financial institutions. Now, with that sort of a setup, it looks like if not us being at the bottom, we are somewhere close to it. This is not a time to be overly bearish. This is a time to actually build portfolios for returns to play out in calendar year 24. Of course, in the near term, you will see some impact on earnings. Nifty consensus EPS is 1103 for FY25. We see downgrades to that. But because markets have corrected over the last 2 years, or thereabouts, say 1.5 to 2 years, we anticipate that much of this sort of downgrade is already in the price. So this is a time to actually build portfolios.
All right. Hi, Anshul. Good afternoon. You know, all of you are talking about food. I was wondering when any of you all will chip in with some drink, but be that as it may, it was a good conversation. Anshul, since you're sitting... yeah, Surabhi.
But you know what, Nigel, just to add, I think we all didn't get to enjoy our Friday, right? Friday felt more like a Monday. So we're treating this Monday as a Friday. So hope, Anshul, just bear with us. That's all I'll say.
All right. Anshul, getting back to the markets then, it's a good time to build portfolios. So what will the allocation strategy be? Will you be looking at value stocks right now? Stocks are trading at, decent PEs with good ratios. Or will you be looking at growth-oriented stocks? The toss-up between the two.
Yeah, Nigel, rather than segregating stocks into value and growth, we will look for earnings visibility. We believe that earnings visibility is what prevents downsides in case of any volatility. At least such companies don't underperform the markets in case there is volatility in the markets. And also, because there is earnings visibility, if they do go down, then investors have the comfort to go in and buy. So for us, earnings visibility is paramount. Combined with that, if we can get reasonable valuations, I think that is Sone Pe Suhaga. That's really what we are seeking. Reasonable valuations with earnings visibility in quality companies. And believe me when I say that I'm spoiled for choice, there is enough and more opportunity in the market where these parameters actually fit in. So that's the way we are looking at it. I don't think that... in fact, time has sort of taught us that if you're just looking for cheap valuations and there is no earnings visibility, then there can be downsides despite valuations being reasonable. That's not the metric that we are seeking.
So Anshul, you said that there are plenty of opportunities and you are sitting on substantial cash. Can you tell us where you're planning to deploy this money? Which are the sectors? Which are the stocks?
Yes, Rima, we think that banking and finance, there is enough and more opportunity. If you look at this space in terms of valuations, valuations are in fact on price to book basis cheaper than pre-COVID levels. Now, while stocks have rallied, but so have earnings gone up and book values have gotten accreted. As a result, on price to book basis, we are at very reasonable valuations, even if we compare to pre-COVID levels. And there is visibility of growth. Of course, in the near term, because of global issues, the macro environment for this space looks kind of uncertain. But here, as I said, we have earnings visibility for the long term, nearly 1 to 2 years at least. We have earnings visibility, and that should give support to this space. We are going to deploy capital here. We believe that capital goods, as also consumer durables, those are pockets which have seen material correction. Some names within those pockets have seen material corrections, and that offers opportunity. Pharma it's not done anything for nearly 6 to 7 years. In valuation terms, again, that space looks to be at the bottom. If you look at what's happening in US, you're seeing drug shortages over there. One thing has to give. Either valuations have to move up or prices have to move up. And even that will act as a trigger for stock prices. When I say prices, I mean drug prices. Even that will act as a trigger for stock prices. So pharma looks like an attractive bet at this time. These are just some pockets that we are seeking at the moment.
Anshul, I'm just wondering if you are willing to take any contra bets in some of the beaten down parts of the market, whether that is IT or asset managers, life insurers, for obvious reasons. I mean, these stocks have really underperformed. Any interest in any of these?
IT, in the last 10 days, the outlook may have changed adversely, but I must say that in IT, again, valuations are not at frothy levels as they used to be till beginning of last year. There has been a material correction. So on a stock-by-stock basis, there is opportunity in IT. We will look at IT going forward constructively. Other than this, I'm sorry, Surabhi, if you could repeat which other segment you referred to.
Anshul, I was talking about the other segments of BFSI. You mentioned banks, but the other segments, life insurance, asset managers. I mean, the whole thesis was a very sort of noble one, financialization of savings, etc. But last couple of months, stock prices haven't exactly, been burning up the charts.
Right. In insurance companies, we would be slightly wary at this time. Just the macro headwind is too adverse. We'd stay on the sidelines, and also valuations are nowhere near attractive levels. Again, asset managers, too many clouds on the anvil. We will be cautious here, although I must say that much of the uncertainty is being spoken of quite vigorously in the markets. And if that is typically when that happens, such uncertainty is in the price. We've seen these asset managers correct quite meaningfully. And so this space may be of interest in some time to come. On NBFCs, there are NBFCs which are quite attractively priced at this time. Look at where gold prices are at this time. And just because gold prices are up, some leverage availability has been created in gold finance companies, for instance. So also in certain housing finance companies, we see opportunity at this time. So within pockets of BFSI, varied pockets, we do see opportunity. Insurance, we would be a little wary at this time.
It's a pleasure. Thank you very much for joining us and good speaking with you.